All right, my friends, so the new month is officially upon us, and what better way to kick it off than with a dividend portfolio update? Today, we're getting all caught up to speed, and I'm gonna show you everything like my best and worst performing stocks for the month, all of my recent moves in the portfolio, and we'll discuss what my upcoming plans are here in April. But before we get to that, guys, I wanna hear from you. Leave me a comment below and let me know what's been going on in your portfolio this last month. Were you up? Were you down? Did you hit any crazy milestones in your portfolio? Anything like that, I wanna hear about it in the comments below. Anyway, getting into how my portfolio performed this last month over here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download the spreadsheet in the description of the video. Starting with my main taxable brokerage account here, guys, we have officially crossed $60,000 in the main account. This is sitting at $60,050, which is the 5th month in a row that we have seen gains and have seen new all-time highs in this account. If we go back to the start of November, which was about when this rally really kicked off, this account was valued at about $46,000. And overall it was down in the red by about 4.3%. And so it's come a long way since then, and like we saw is now at $60,000 with a current unrealized gain of about 17.2%, with the month of March being just an incredible month for me. According to Charles Schwab, just in the last month this account grew by $2,674, with the majority of that, as I'm sure you can imagine, coming from share price appreciation. It looks like my investment gains in the month of March were about $2,516, and throughout the month I brought in almost $160 of dividend income, with some of my largest payments coming from Realty Income here, who paid me $25.69 for the month, and Johnson & Johnson, who paid me $38.43. Now, if you want to see the full breakdown and see all of my dividend payments from this last month, then check out the video I've linked in the pinned comment. I go through it all there. But anyway, guys, between this month's gains and dividend income, that leaves me with a rate of return of 4.65% for the month, which is really solid. And for the first time in a while, I actually outperformed the three major indices. The S&P was up 3.2%, the Dow was up 2.2%, and the NASDAQ was up 2.8%. So we're looking pretty good there. Now, if we look at the year-to-date performance, I am still underperforming for the most part. So far in 2024, my portfolio has grown by about 7.5%, which is still underperforming the S&P, and I'm also underperforming the NASDAQ by not too much, by about 1.1%. And then zooming out once more, looking at my returns over this last year, I think this is looking pretty good. I'm still underperforming, okay? I'm up 19.2%, which in its own right is pretty solid, but like I said, I'm still underperforming the S&P by quite a bit. I'm still underperforming the Dow, and I'm also still underperforming the NASDAQ by quite a bit. And then comparing my portfolio's performance to SCHD, the holy grail of dividend ETFs, I am outperforming this bad boy across all time periods. Although SCHD did have a pretty solid month, and SCHD also did outperform the S&P, the Dow, and the NASDAQ with a 4.13% return. But year to date, it's still lagging. It's up 5.91%, so I'm still beating it by about 1.6 percentage points. And in the last year with a 16.4% return, I'm still beating SCHD by almost 3 percentage points. So overall, we're continuing to make some great strides, guys, and it's kind of mind-blowing, at least for me, to see the main account up over $60,000 when it really wasn't that long ago that this wasn't even touching $50,000. Like 5 months ago, this wasn't even at $50K. And I've got to say, as someone who started investing just a few short years ago with practically no experience whatsoever, seeing the performance of this portfolio and seeing the dividend income continue to grow is really exciting. And it makes me so happy that I decided to start investing even though I had no clue what I was doing at first. You guys will have heard me say this before, but I didn't go to school for this stuff. I've pretty much learned everything I know about investing so far on my own as I've gone along. As my friend Ari Gutman would say, I've been enrolled in the school of hard knocks. But in hindsight, I wish I would have pursued this stuff more back in the day when I actually was going to school. I think learning about finance in a more formal setting would have been a really good thing for me, and I think it would have really come in handy, especially as a beginner investor. And with that in mind, I want to tell you about today's video sponsor, Southern New Hampshire University. As someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said that I've never thought about going back and finishing my degree. And if you feel the same, if you feel like your lack of experience is holding you back from pursuing the career career that you really want, then I'm excited to tell you about today's video sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn how to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll also learn how to generate financial records and financial statements for users in accordance with governing rules and regulations. And along with all those things, you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU was voted one of the country's most innovative universities by US News and World Report, and it is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on the call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryan or just find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryan. Now moving on, guys, we're going to take a look at my best and worst performing stocks for the month, starting here with my best performer in the month of March, which was Williams-Sonoma, by far. Just in the last 30 days, Williams-Sonoma was up 35.22%, which is unreal, and this represents a 57.36% return so far here in 2024. The stock has just been on fire. And with that, taking a look at my position, all of these gains from Williams-Sonoma leave me with a near 140% share price return and put me just over that mark if we include dividends in the calculation on a total return basis. So this is hands down my best performing position, I think, of all time. Anyway, moving on, my second best performer in the month of March was Snap-on, who also saw a really nice gain in March. They were up 7.7%, which leaves them with a year-to-date gain, which is a bit lower, but still a little bit in the green, up 2.5%. And looking at my position, Snap-on is another one of my portfolio's top performers just in terms of share price. I'm up 40.36%, so this one's done really well for me. And on a total return basis, it's done even better. I'm up closer to 47%, almost at that 50% mark. We'll get there as those dividends keep rolling in. And then last but not least, guys, the Southern Company also was a really solid performer in March. They were also up 7.7%, very similar to what we saw with Snap-on. And looking at their year-to-date performance, it's also not anything too crazy, up 2.3%. But still, my Southern Company position is doing pretty well. I'm up 19.5% in terms of share price, and I'm up about 33% on a total return basis. So all three of those did pretty well for me this last month. And now, on the other hand, in terms of poor performing stocks, there's really only one in particular that was down a meaningful amount. And that was Apple, guys. Apple was my worst performing position in the month of March. They were down 5.56% in the last month, but Apple's been on kind of a downward trend anyway this year. As we can see here, they're down almost 11% year to date. But what really amplified this was news about the DOJ suing Apple for what they believe violates the Sherman antitrust laws. In a nutshell, the Department of Justice thinks that Apple is stifling competition by not allowing other developers to offer their products, like digital wallets, for example, on iPhones. They think this is anti-competitive behavior and makes it difficult for iPhone users to switch to other phones or even to message people who don't have iPhones. Now, Apple, on the other hand, says this lawsuit misses the point. They argue that they're all about making great products that work well together, and this lawsuit could mess that up. And in essence, they feel that they're being punished for essentially being successful. Either way, this lawsuit is certainly a headwind and a distraction for the company, and at least here in the short term is creating some negative sentiment around the stock, which is what's pushing the share price down. But hey, could be a good buying opportunity for Apple, and let me know in the comments below if you're buying any shares of Apple here on the dip. And now moving on, guys, and getting into all of my buys for the month. It was a pretty straightforward month of purchasing. In the main account, I really only purchased Visa. Throughout the month, I ended up adding 2.1 shares of this company at an average cost of $281.54. And that was pretty much, like I said, all I bought in the main account in March. And with that over in the Roth IRA, I continued to dollar cost average into both SCHD and VU. But starting here with SCHD, I ended up picking up 4.28 shares throughout the month at an average average cost of $79.02, which if we take a look at my position, leaves me sitting at 65.68 shares of SCHD. And my goal by the end of the year is to get to 100 shares of this ETF. And at this point with my weekly contributions, I'm adding about 1 share, maybe just above 1 share on average. So I definitely think we'll get there by the end of the year. And then as far as VU goes, I only picked up about half a share of this ETF throughout the month of March. And my average cost for these purchases was $470.42. And with that, now moving on and taking a closer look at my Roth IRA. As we close out the month of March, it is valued at $8,793, which is quite a big jump compared to where we ended up last month at $7,945. So that's pretty sweet. And throughout the month, I brought in $50 in dividends, saw a share price gain of almost $300 throughout the month, which leaves me with a 4.4% return for the month. Now with that, on a year-to-date basis, this return is looking pretty dang sweet. I'm up almost 8.5% for the year. And if we zoom out looking at the all-time returns here, I'm up 33.3% in the Roth. That's pretty solid. And with that, if we take my main taxable brokerage account, which is valued at just over $60,000 and is generating $2,370 of dividend income, and add that to this Roth IRA at $8,793 and it's generating $222 of annual dividend income, this is going to leave me with a combined portfolio value of $68,843, and my projected annual dividend income here is $2,591, which is a pretty decent jump compared to this time last month. At the end of February, last month's projected annual income was $2,553, so we climbed by almost $40 in the month. And if we look at the income gain year to date, we started off 2024 at $2,473 of annual dividend income, which means just in the first quarter here of 2024, I added almost $120 to this projected annual income. And if my income keeps growing at this same exact rate, then I can expect a year-to-date increase of $472 by the end of the year, which would put me at $2,945 of projected annual income going into 2025, which would leave me about $55 short of my goal of hitting $3,000 of projected income by the end of the year. However, I do expect the income growth to be higher by the end of the year because this calculation here is linear and it doesn't take into account reinvested dividends, which in reality would make the income growth more exponential. And so all in all, I think $3,000 of projected annual income by the end of the year is still in my sights, and I'm pretty confident that I can get there. Now, as far as my watch list goes, I added a couple new stocks to this list in the last month. The first one that I added to this list is Yum Brands Inc., which is the company that owns fast food restaurants like KFC, Pizza Hut, Taco Bell, and The Habit Burger, and this company operates primarily on a franchise model, which is interesting to me. So I wanted to dive into this company a little bit more, really so I can learn more about that, and we'll see if there's anything there. And then the other company I added to this watch list is Zoetis, which is the world leader in animal health. I think there's a lot to like about this company, and I actually think Zoetis looks like a really good buy right now, which I'm telling you more about in this next video right over here. In this one, I'm telling you about 3 deeply discounted dividend stocks, all of which look like great buys right now in the month of April. So click right over here to check them all out, and I'll see you in the next one.